Hi there, this is Erik Egelko, and I am super excited to announce episode number 3 of the Easy Deals podcast, sponsored by Palm Tree Properties. All right, welcome back. Well, today I am very fortunate and excited to have a incredibly talented guest in the audience. We have Dillon Freeman, who is a senior loan officer with Fidelity Bancroft Funding, a nationwide commercial mortgage company. Dillon, welcome to the show.
Thank you so much for having me.
So Dillon works in the commercial mortgage business and has an extensive background with financing and underwriting, which we are going to get into shortly. But before we do, for our less educated members of the audience, tell us a bit about what your job is. What do you do?
So I spend my day looking for commercial real estate loans that fit my box. So I speak with brokers and asset owners who are looking to buy or refinance real estate. I look at that opportunity and decide if it's something that we would lend our money to do. And if not, I can go turn around and broker that loan to another lender or a bank or an insurance company. We do a lot of different programs within our verticals.
And for someone who's involved in a commercial real estate transaction, whether they are a buyer or a real estate broker, what would be the value proposition to them to work with a mortgage broker?
One of the things that we do is we stay up to date on who's lending and what their parameters are. Right now, there's been a pretty large shift in who's really active in the market and who's looking to do business and who is not. You will find it in the loan programs and in the nitty-gritty details of what people are telling you. And it takes a lot of time to figure out who the right match might be. And because of that, you can save a lot of time and get a lot of value out of using a broker or going directly to a lender who also brokers as well.
I would think, additionally, being that you have so much context on what is available, that oftentimes you save money on pricing as well versus trying to find the lender yourself.
Yeah, so one of the benefits that we have with, for example, the bank programs that we run is we have wholesale programs where it may offer the best rates that the bank has on that particular product. In addition to that, typically those products are run on a par pricing model. What that means is they have their pricing that's, let's say, 6.75%. And if you hit all of the LTV and the DSCR parameters on that deal, the bank will not charge the borrower another fee. So the borrowers really only charge one fee for that transaction rather than both a loan origination fee and a broker fee on top of it.
So there was a lot of great information there, and we're going to dive into the nitty-gritty here shortly. But why don't you tell the audience a bit about your background? You know, how did you get into commercial real estate and sort of take us from the beginning to where you're at now?
Sure. Yeah. So I got into the industry on accident, really. I graduated from UC San Diego with a degree in management science, which is an economics and math sort of joint major. That was not what I planned on graduating in. And going into the job market in San Diego is not a very large financial sort of hub like a Los Angeles or a Chicago or a Dallas or a New York. And I looked around for quite a while, found actually an internship opportunity with AXOS Bank, which was then called Bank of the Internet. I was finishing up some Spanish and English night classes and ended up getting the opportunity, and within a couple weeks I actually had my full-time job offer. So that was as a junior credit analyst, really handling the portfolio of loans after the bank had already made them. It's a great starting role because there's not a lot of risk. The loan has already been made. You're not given a lot of responsibility and decision-making authority, so you can make mistakes and learn as you go. So from there, I was in that portfolio management group. I moved over to an income property underwriting group where we underwrote loans for small balance commercial, mostly multifamily loans nationwide. The way that worked is a loan officer would bring in an opportunity. They would put it through a loan sizer that plugs in the rents and the profit and loss statement and the economics on the financing and says, does this loan make sense or not? So I would initially screen those deals. And then when we actually got the LOI back, the LOI, which is basically a letter that the bank gives you that says, here are the terms of your loan, here's the recourse, here is the cost, et cetera, you sign it, the process gets started, and that's when the bank's work really starts, ordering the appraisal, looking through the appraisal, really tightly reviewing the rent roll and looking for any inconsistencies or anything weird, going over the insurance that's on the property. All those sort of really detailed things are involved in underwriting. And I actually found out I don't love that type of detailed work very much.
Yeah, I mean, I'll tell you, my head is spinning a little bit currently just based on all the industry vocab that you spit out there. However, Dillon, I can appreciate that you have experience in the underwriting portion of it, because my experience with working with mortgage brokers is they can be incredibly optimistic, and that it's such a competitive industry that they'll tell every borrower yes to get them in the door. So do you feel that your underwriting experience has made you more conservative as a broker?
Absolutely. So further than that, also, I spent time in special assets. So special assets is when loans the bank has are going bad for any number of reasons. They've stopped payment. People are looking at the financials on the property and seeing it's not making money. It comes to the special assets group to be worked out and monitored. So I have seen all of these ways that things go wrong, and because of that have become much more conservative. To your point, it does make me a little bit more pessimistic in terms of what can be obtained on a property. But I think that it is a strength of my business that I can look at something and say, hey, someone's going to tell you you can get this type of leverage, but I'm here to tell you that on this type of property, it's unlikely you're more likely to get this, or this may be a cost saving to you to go this other route.
So you were at AXOS Bank in a underwriting capacity. What was the journey from there to your senior loan officer position now?
Yeah, so we had a group at the bank called Lender Finance that I eventually found my way into, and that group focused on, as the name would imply, financing different types of lenders. Specifically, there was a real estate segment and a non-real estate segment. I did a little bit of both: the underwriting, the portfolio management, the deal intake. Eventually, I was recruited by another bank to be an originator, an actual relationship manager to originate that product. And unfortunately, after a little over a year during the banking crisis last year, I was laid off. And I was faced with the decision to go back to banking, which was a little bit shaky at the time, or try something new. And actually, initially, I went to work for one of my other clients for about 6 to 8 months before ending up where I'm at now.
So the banking crisis, this is the Silicon Valley Bank, Signature Bank, First Republic Bank. I got caught up in this a little bit because I was a First Republic customer, and I'll tell you, the loans were so good they put the bank out of business. For people who don't really understand what happened with this banking crisis, can you give sort of like a layman's explanation of why did all of these banks have this problem?
Sure. Somewhat related, but also unrelated as well. The main issue that happened at First Republic was that people were taking their money out of the bank faster than the bank could provide them with that money. Because when a bank takes in a deposit, it's their job to take that money and then invest it for a return so that they can pay the interest and also make money for the shareholders. So those assets are generally not liquid, right? It would be 30-year mortgages, which are not liquid. It would be commercial real estate loans, which are not liquid. It would be government bonds and mortgage bonds, which are not liquid. And so what happened was, I believe the number was like over $50 billion was pulled out of that bank in a matter of, I think, maybe just a week.
Wow.
And so in converting those assets, they would have to sell the assets at such a loss to convert them into cash that eventually the regulator stepped in and said, you don't need to do this anymore, we'll take it from here.
So this temporary banking collapse of the regional banks happened, and you were sort of out on your butt without a job. That I imagine was probably a big shock. Tell us, emotionally, what was that like?
It sucked. So at the time, actually, my wife and I were expecting a baby. So I was set to start my parental leave and ended up having the baby 4 days after I was laid off.
Holy cow.
So in addition to searching for a job, I was also learning how to keep another human being alive. So it's a very, very stressful, very tenuous time. Fortunately, I've kept some really good relationships with people that I've worked with over the years, and I had offers almost immediately, but I was trying to find the right next step for myself. I learned that in banking, I didn't want to move up from where I was. I looked above me at people that I admired and mentors and people that I had worked under. And I didn't want their job. Their job just involved more hours at the bank, more responsibility. It was great pay, but there was no real independence to it. And in a lot of roles, you don't really have any decision-making authority at the end of the day. So to me, it was a good time to branch out from that and bet on myself to become an originator of bridge loans.
It is uncanny that the parallels between you and I, Dillon, because my wife and I had a baby last year, and I decided voluntarily to quit my job concurrent to having the baby, which in retrospect was way too many life changes.
I would not recommend that.
No, you really miss a lot of components of getting away from a baby and being around your coworkers when you have a 2-week-old who only sleeps for 30 minutes at a time. But for me, it was similar that I was a top producing commercial real estate broker, was making tons of money, again, all the accolades, but I was looking at the people who were 10 to 20 years further down the road in that same role. And I mean, they were... most of them were divorced and, had a big bald spot and were kind of just like generally angry people who had made all of this money but weren't enjoying life. And it became clear to me that I wanted to focus on, creative projects like this podcast, on doing my own investments and, as you said, betting on yourself. And I'd much prefer the upside of being self-employed than the safety net of having a big company, which I think you can probably relate to.
Absolutely.
So you jump into this effectively, it's a merit-based role. You don't have any kind of guaranteed income. What was the buildup like in the beginning of your career?
In this new industry?
This new commission-only type
I struggled.
of gig.
It wasn't great.
From the time that you basically went commission only, how long until you got your first substantial payday?
It took probably 4 or 5 months.
Wow.
To have like a decent payday.
And what do you remember what that deal was?
It was a small deal that was an absolute pain to get done. That ended up going delinquent later, actually, I found out.
Wow.
Yeah.
Well, maybe your special asset guys can hop on that.
Fortunately, we didn't do the loan. We ended up actually brokering that one. So we did all right on that. But that one was not worth the time that I put into it. And actually, what happened was that broker had brought me a couple deals at the same time, one of which went bad. The other one, he had brought to me in a sort of desperation that they were out of lenders and they couldn't get this done. I figured out a way that we could get it done through a white label program. So a white label program is a program where a lender has the ability to originate someone else's loan product under their name, right? So this was XYZ lender's product. We have all these documents that are their documents with our name on them. You send it out, they underwrite it, and then you get your name basically on the loan, you get control over the situation. And during this process, this broker had said, hey, I recognize these documents. He was an experienced broker, and he said, we will never, ever, ever do a deal with this lender. This deal is dead, hard stop, no negotiation. And as I always do, when I lose a deal, I follow up monthly, every couple months, quarterly to see who won the deal because I want to know where to take it the next time. Or I want to know who's lending on that the next time. And I found out they did go to that lender.
Oh, they try to just circumvent you.
So that was my first experience working with untrustworthy people. I came from the banking world where almost everyone I was working with was internal. To be sort of thrown out to the wolves in this new industry, that was a learning experience for me.
It's... I have had a ton of these experiences. I had one in the beginning of my career. I was doing a lot of commercial leasing, just because most brokers, that's where you start out. And I had a pocket listing on an automotive space in Miramar. The owner was an elderly woman who hated brokers, didn't want to sign a listing, but she told me she'd pay a commission. So I brought her a tenant. The tenant had a great setup. The LOI looked really good. I sent her the application. 85-year-old lady called the tenant directly off the application and said, ditch your broker and I'll lease you the space. But
How early on was that?
that I was probably 6 months in.
That hurt.
At that point, but it was you know, in the beginning, you're just so excited because there's this prospect of making these enormous fees, and you almost drink your own Kool-Aid in terms of you want to believe everything that's true. And I would imagine, especially with borrowers, you have tons of people who are, you know, blowing smoke in terms of what they're telling you their credentials are.
Totally. Yeah.
So, many people get into one of these commission-only loan originating gigs, and it does not work out for them. I would think the attrition in the first year is probably super high. So what have you done differently that has allowed you to build and have your business snowball into the point where now you're making more money than you would have in a salaried-based job?
I'll be honest with you, I'm not.
Okay.
I'm not there yet. You know, I've closed probably about $5 million in transactions in the last almost year now, which
Okay.
which wouldn't be horrible for a first year in another role, you know. But I am still, I think, seeing the fruit of all of the effort that I've put forth to this point. So take you back to when those deals came in. Those are the only things I had on my pipeline, the only thing that I had seen in weeks and would see for weeks. Now I'm getting a deal sent to me every day. And so going from looking at 1, 2, 3 deals a month to now, I just did my numbers for the last month. I looked at about 30 deals for about $150 million in requests. Now maybe about 5% of those are doable deals that I'll bid and I'll go after. It's taken a lot of time. It's been exhausting and stressful, but I feel the momentum continuing to build. And it's funny that you asked me about that other situation just before asking me about this, because I can compare where I was then and the efforts that I was putting in then to what I'm doing now, and it's completely night and day.
Yeah, no, I think back to, I mean, it's like you're always evolving and you're becoming more efficient and more effective. And I think about some of the things where I just exerted tremendous effort to try to put together a deal that had no chance of being put together. And then, you know, nowadays I'll do a deal and, you know, you do get some easy ones where everyone just does what they said and you feel like you made this enormous fee. So I feel like it's you can only learn by making those mistakes, and you can never you know, read in a book what to do when the broker circumvents you. You know, there's not a YouTube video, at least not yet, talking about what they do. So transitioning on to a more inspirational note, tell us about a deal that you've closed that you felt was like just a home run, like one of your most lucrative deals you've been involved in.
So I would say that happened before I was in a commission-based role. I don't feel that I've had that deal yet, which is good. I think it keeps me hungry and it keeps me moving forward with what I'm doing now, that I haven't had some huge check that I'm not worried about getting paid for 6 months or anything like that. Also, between the origination fee and the commission split, it is less lucrative to be a lender than it is to be a direct commercial broker that's selling a property, right? Because the brokerage might make 2 to 3% on $5 million. What is that? 100 to 150 grand. Well, the lender might make a point, which is 50, and then the depending on where they're at, the loan officer might make half of that. So you don't get this 6-figure payday.
You gotta be cranking a lot of volume.
Unless you're cranking out a lot of loans or you get a big one. And so what a lot of people end up doing, they get really distracted by this shiny object and they'll spend 3 months shopping a deal that has no chance of happening. And so one of the strengths that I think I have is I haven't fallen for that, because I've closed deals in other roles that were $100 million. So it wasn't a commission-based role, but it was still that exciting feeling that, oh my God, I closed a 9-figure deal. So to go back to your question, I would say a deal I was really excited about closing. I was the underwriter and sort of the lead analyst on a commercial development loan that was like a 5 or 6 story multifamily project in New York. And so it was cool because it was New York. New York's kind of edgy and sexy. And I was maybe like 24 years old. And this was like $100 million project that we were participating, I don't know, like $20 or $40 million. So it was a big, big number to me. And I hadn't done a development loan before, and there were a lot of headaches. And so when that got closed, that was very, very exciting for me.
Hell yeah.
Yeah.
And how long ago was that?
That was early in my career at AXOS. That must have been maybe 6 years ago.
You ever go by some of these properties and you're like, oh shit, man, I did the deal for that.
So it's really funny you bring that up. So there was another development loan. So this client of ours was a national footprint lender. We would lend to that lender on their portfolio of loans. So they had this deal that we would underwrite each individual deal when they came in because they were so lumpy and unique. And it was in Clearwater, Florida. It was a condo project. And for whatever reason, somehow the stars aligned, and my sister had her wedding like 3 blocks away.
Oh, no way.
So we went out to Florida for this wedding, and the wedding was in Clearwater. And I thought to myself, and this must have been maybe 3-4 years later, and I couldn't remember the address or anything, right? And I thought to myself, I wonder where that project is right now. And I walked down the street and I got to see the project. That was the first time I got to see that come to reality. That was really cool.
Yeah, no, I mean, it's really satisfying just because, the television portrays our roles as, we're always in these high stakes meetings and at these crazy properties. When I mean, in reality, we're all sitting behind a computer screen making phone calls in an air conditioned room. It doesn't have quite the sex appeal that people would otherwise think. I'd like to thank today's sponsor, Palm Tree Properties, San Diego's premier property management company. If you are a rental property owner who is tired of dealing with tenants and termites and toilets and just all of the headaches that can come with investing in real estate, consider reaching out to a company like Palm Tree Properties that can help you make more money and provide more peace of mind. All right, back to the show. So you've had a lot of great stories, and I think what many people find to be most relatable is not as much the triumphs, but what you have learned from the setbacks. You have a specific story about when things just did not go your way and kind of what the lesson was from that.
Yeah, I mean, the one getting circumvented by a broker is obviously a very good one. We had another transaction that we worked on. I spent months on this. I thought it was the real deal. I had even mentally accounted for the check that was going to come in, right? Like as far as I was concerned.
Big mistake.
Yeah. They'd seen the LOI. They said they were good with the LOI. We were ready to move forward. And what ended up happening was maybe we jumped the gun a bit. Maybe we should have done a bit more digging, because as soon as we began to unravel things, they were not as they seemed. So we started to unravel these layers of entities that owned this project, and there was this circuitous layer of ownership and entity and a holding company and all these things, which it's totally normal for someone to have that. And I'm very familiar with these structures. It's typically linear. There's a holdco, then there might be like a regional thing, and then there's individual assets underneath or something to that effect. But this one had people we didn't recognize and entities we'd never seen and entities we couldn't get documentation for. And as soon as we started asking those questions, the borrower stopped answering the broker that brought it to us. And that was more than likely, as far as we've interpreted at this point, to probably have been a fraud.
Wow. So, I mean, beyond determining, is this lucrative enough for the bank, you also have to determine, are these people just trying to run with the money?
Right. Yeah. Trust but verify wouldn't even put it right, because it's you don't initially trust. Everything, you have to see it, and then I still have to verify it to believe it. For instance, if someone tells me anyone can write on a piece of paper that they make $1 million a year, and unfortunately, as Trump is now being litigated for, right? You can't just put random numbers, not saying that he did, but you can't just put things down and not expect it to get checked. But people will typically inflate their income, the value of their assets, any number of things in a loan submission to make themselves appear more favorable. So because I came up in that environment where I was at a bank and and we have regulators looking over our shoulders and checking our work, I never really started from the place of trust. Everything was verify or get a real source of firsthand documentation.
Yeah, I mean, we deal with this same thing day to day in our property management business, is that I have found that calling a tenant's current landlord is actually not a very reliable source of what kind of quality tenant they are, because that landlord may be super motivated to get them out. So if I'm being completely honest, I've fallen victim to the same thing, is that I've had a really bad tenant who I've given a positive reference to, because I'm like, yeah, just get them the heck out of here. I don't want them anymore. So what we have found is that we will call their second most recent landlord, who they've also already moved out from, and that person I found to be way more honest. So switching gears here for a sec, you have started this really compelling series on LinkedIn about potentially troubled assets here in San Diego. And honestly, I would say that this is like the highest quality stuff on LinkedIn at the moment, if you're in the real estate community here in San Diego. So definitely, after you watch the episode, connect with Dillon on LinkedIn so that you can start seeing some of these posts. It seems like it's mostly like coastal multifamily assets that the sponsor just got over the skis. Can you tell people a bit about what you're doing and kind of the narrative of these stories you're telling?
Yeah, so the idea was to illustrate the financing problem that everyone talks about, but to put a real concrete sort of example behind it. Everyone has talked about this commercial real estate wall of maturities and how the numbers don't work, and I wanted to figure out a way to illustrate that in a concrete example that was a little bit more compelling. So what I did is I had Title pull a list of all of the properties that were financed in all of the multifamily properties in San Diego that were financed in the last 3 years. And I started working through the list, and I sorted them by initial leverage, which is the loan to the initial purchase price. And one of the things about that is the loan will also include the rehab budget. So sometimes that number can look astronomical, or in the case of a development deal where someone bought a lot for $1 million and they're putting up a $30 million structure, we'll spit out some crazy numbers. So there's a lot of data cleanup, but I'll sort based on that and loan per unit and look at these individual properties. And I spend a couple hours on this each week, and I try to identify a property that truly could be troubled if today they were asked to refinance. That's really what's in the guts of this thing, right? Is if you had to pay off this asset today, could you? So I try to avoid situations where it says there's 30 years left on the loan, or where there may be several years left. I try to pull something that seems to have some sort of apparent, more urgent type of scenario. So I started writing it and got a lot of really good feedback and have sort of kept it going. And I'm on week 13 or 14 now, and it's getting harder to find assets. I will admit that. I do my best not to sensationalize. I really try to stick to the facts and not make it personal. The idea is, here are my assumptions. Here's how much this asset is financed at. Here's what market terms are. And here's how much debt it could support today based on what I know.
Yeah, I'll tell you, one of the things that I really like about these is that you'll break it down in these like easy to digest numbers. That's like, at current interest rates, you got to rent these units for $4,200 a month, and they're in a submarket where rents are $2,800 a month. So it's like, what are you gonna do? Do you have one specific that you remember that you can kind of just run through the numbers quickly for us?
I'm not that type of savant, but most of the issues have been on projects that have leverage that doesn't make sense on a dollars per unit sort of basis. So in San Diego right now, price per unit maybe about $400K, coastal-ish, right?
Yeah,
$400K, give or take,
mix of 1 and 2
10%.
bedrooms maybe.
So when I see $300,000-$400,000 per door, that tends to jump out at me, and that's why I'll pull the asset up on Google. I'll say, are there any garages here? Is there any empty space for an ADU? Like, help me make this make sense. And so those are the ones that really stick out, where it's like, that price per unit, or I see 120% loan to purchase price, right? So unless you're building a new structure, or at an extremely attractive basis, I don't think those numbers tend to work. And so those are the ones that tend to jump out at me.
So a sponsor of a deal who over leverages themselves like this and is now faced with a maturing loan, what are their options?
Well, there are a lot more people that are more knowledgeable and creative than me, but I see really two primary options here. Option number one is sell. Even if you don't have equity in the deal, the longer you wait, the worse it is likely to get. You can pray for rates to go down and for cap rates to compress, but more than likely, based on the research that I've seen, getting out sooner is better. Option number two, if there is equity and if the numbers could make sense someday, would be some sort of mezzanine preferred equity type scenario, which I actually see as slightly riskier than trying to sell the asset, because in that case, typically what will happen is there's a piece of equity that is higher in priority than the owner's common equity, right? And in order to make this risky investment, this person needs a return of 10, 15, sometimes 20% that they're targeting. So there may be a current pay, but if the asset is unable to support the debt, it's unlikely to be a current pay. So this preferred investor will be accruing basically an IOU from the sponsor. And what can happen is if you take 12, 18 months, the amount of equity that you did have essentially can evaporate. So I know there's been a lot of talk about preferred equity and mezz debt and how much has been raised for this cycle. But the problem with this current cycle is that it's a cost of financing issue. It's not really an asset value issue. It's that you can't support the debt at current market terms. And the only way for that asset to be able to cash flow that out is for debt to hit the floor again. And I personally am not of the outlook that I see that happening.
So I'm glad that you bring that up, and I want to get back to these troubled assets here in a sec. But one of the most common questions that everyone in the real estate community gets asked is what's going on with rates? Are we going to see a big reduction in rates in the next 12 months? What is your perspective on that?
So not to toot my own horn, but a bit of background on that. I did spend 4 years becoming a chartered financial analyst, so I do have more training on this type of thing than the average bear. It does not make me an expert. They don't train you on Fed watching. But what I do know is that most of us have operated, and most people operating in the industry in general, have all been post-financial crisis. In the financial crisis and during COVID, what happened then that's never happened in any other time is that the government, the Fed, however you want to describe it, brought interest rates across the curve down to essentially zero. There's been other times where they've brought the Fed funds rate down to zero, but by doing the quantitative easing where they buy up assets and buy up treasury securities, they depress the whole curve. And so we're used to this environment where when anything goes wrong, the two times things have gone wrong in our general lifetime. I know you're a few years older than me, but you probably weren't working in the 90s. The only times that this has happened in most of our lifetime is everything went to zero. And the problem is that that's unlikely to happen unless things get really, really bad. And so my outlook is we might do it again. I don't think we'll do it again, but if we do it again, the fundamentals that everyone's talking about, that rent is still high, that unemployment's still low, that delinquencies are still relatively low, are probably not going to be there. Mm-hmm. So my outlook is unlikely to happen. If does happen, it will be a lot uglier than you trying to refi your debt at the current value. The value will probably not be there.
Okay. Well, I think that is a very sophisticated perspective, because what I hadn't considered, and as I was thinking listening to you, is that if the government drops rates, it is in response to something. They are not doing it because they want real estate investors to make more money. So it's everything has to reconcile that if all of a sudden we're going to have 4% mortgages, it means that we have 15% unemployment, or it has to correlate to something. So given this challenging environment that you're in, where do you see the opportunities?
I see an opportunity in refinancing some of these assets, although it does involve cash in. So what a lot of people have done is they're surviving till 25 has been the the term, right? And what that means is it's a lot less expensive for me to pay a 1% extension fee and to pay to carry my loan for additional term than it would be for me to bring in 10, 15, 20% of my equity as a cash in to refinance. So that's what a lot of people have done. So I think there is an opportunity for refinances in some scenarios. And that's really sort of where we're looking. I'm focusing my business not on, because don't forget that I'm a lender first and a broker sort of second. So I'm looking for deals that I want to lend on. Typically, I'm not going to want to lend on a busted deal or a troubled deal, right? Because if the borrower has a bridge loan and they have no choice but to get another bridge loan because they don't have the cash, the equity to bring in to refinance at bank terms, I'm unlikely to want to do that deal. That sponsor's probably not in a situation where they want to do that deal. So I'm focusing a little bit less on the transactional volume, and all of my goals with my boss are focused less about the volume and more on the inputs. How many relationships am I making? How many meetings am I going on? And then also advancing those relationships. So taking it from, a cursory relationship and going to lunch or spending some time together to build that familiarity and also offer value. So I'm also, anything that's been on the open market, I'm looking at you, San Diego brokers. I've been sending out deal quotes on all the active multifamily opportunities saying, hey, here's where banks are at, here's where we're at. Sometimes I'll even throw in another program that we may be able to broker. So I think that focusing on building that network is helping me with the lack of deal volume that's out there right now.
So here we are. It's the first week of June in 2024. If I had a stabilized multifamily deal, what would general pricing be for something like that?
For a bank?
For bank loan.
Banks are mid to high sixes right now. There may be some that can get lower. Typically on larger loans, they're willing to be a little bit more charitable. Also, if there's a depository relationship. So somewhere in the mid to upper sixes is pretty market right now. 120 debt cover. And what that means is for our market pricing, where we're in the maybe mid 4 cap rate range, meaning that the total asset can only produce a 4.5% yield. And then the debt that's part of that cap stack has to have a 6% yield plus the amortization, maybe like a 7, 8, 9% debt yield, means that most of these assets have to be financed below 50% loan to value for the numbers to work.
I would think that with this, we had this great wave of cheap money through COVID. I mean, you were buying stuff with 20% down.
I missed it.
Yeah. Now that it takes so much equity to put a deal together, are you seeing, less low quality sponsors shopping for loans?
I almost want to say the opposite.
Really?
So my perspective is skewed because of when I entered the market, right? I entered the market about a year ago. So I'm already looking at things in a time that I would consider to be sort of bumpy, right? But I think that there's a lot more bad deals out there chasing refinances or people chasing deals that don't understand the sort of macro environment surrounding them than great sponsors with great deals. But also, great sponsors with great deals might go to one lender and they do the deal. Mm-hmm. Right? Sponsor goes to one lender. Lender says, you're a great sponsor with a great deal. I do the deal. A bad sponsor goes to a lender. They say no. They go to another lender. That lender says no. Then they go to a broker. And the broker says, I got you. And you know what they like to do? Blind copy all of the lenders they know on one submission package that has no information. And so I see a lot of that because I'm getting started and I'm building some of these relationships and learning what relationships are worth growing and spending time on and which ones are going to send not so great deals. So I see a lot more bad deals than I see good deals, but I think that's the nature of the environment and also just where I am in the industry.
So some of the people watching are aspiring real estate investors who working with a bank or a mortgage broker is going to be paramount to their success. So what would your advice to a prospective borrower be? Basically, how can they get the best deal from you? What can they do to make your job easier so that it's more attainable for them to get financing?
So in the same way, let me back it up. Most people, the maybe the only real estate financing transaction they'll ever do in their life is their home. Everyone has the same advice when you're shopping for a home, right? Get your documents together and get pre-qualified. And that would be the work of working with a commercial mortgage broker, right? Get your documents in one place, let them look at the property, let them help guide you on sort of level setting expectations and who might be interested and at what levels and what cost. And then you can sit down together and say, okay, based on this scenario and my financial situation, here is the best choice for me, right? So instead of starting with the deal or starting with parameters for loan programs, you just start with, hey, let's collect your personal financial statement. Let's collect your schedule of real estate. Let's get a rent roll for the property and a recent P&L. That can give someone a really, really good idea on whether or not they're going to be interested in this opportunity. And it amazes me the amount of opportunities that I get screened past me that it takes 2, 3, 4 weeks to get that PFS or personal financial statement or schedule of real estate, right? Which outlines your assets, your liabilities, your net worth, and then the real estate you own, where it is, how much it's worth, how much the mortgage is, all that sort of stuff.
Yeah, I endorse that completely. One of the things that we try to do, because we're often looking for financing for our deals, is I file my taxes in January, and I keep all of my ducks in a row. And when I do go to a bank, I can just send them a Dropbox folder with everything perfectly labeled, and they appreciate that a lot. And at the end of the day, they're going to make loans to people that they like. So, but by making yourself an easy to work with person who's diligent and who's organized, you will very much get prioritized in the eyes of the bank and the underwriters. Let me ask you this: what are some of the biggest mistakes that you see people make when they're shopping for commercial mortgages?
So most of my business comes from brokers. And you mentioned earlier, a lot of brokers haven't been on the underwriting side or on the actual lender side. They're sort of in the business of finding people and finding lenders and putting them together to do their thing, right? So I find that a lot of brokers want to over-explain the deal or tell me how strong the borrower is by saying, "Don't worry, he's really wealthy," or certain things like that are a red flag to me. If you're saying, "Don't look over here," I'm going to look over here. If I say, "Don't think of elephants," what are you doing right now?
Thinking of elephants.
That's right. So, not overselling the deal, letting the facts speak for themselves, and just being prepared, because the documents that I mentioned are going to be required no matter who does the loan. Hard stop. So you might as well get them out of the way.
Yeah, no, it's funny that you mentioned that. I do on a very, very small scale. I lend some money in a private lending capacity, and from time to time, brokers will approach me, and it's like the perfect application to me is self-evident, and you can explain it to me in 30 seconds. It's you get the classic mortgage brokers like, "Oh, he's such a great guy, and he's done all this stuff, and he has this resume, and he has all these properties."
It's beautiful. You should see it.
Oh yeah, no, it's such a good location. Blah blah blah. And to me, it's like it should speak for itself. The more you talk, the more I think this is a bad deal.
That's a great point. Do you have any horror stories or any deals you shouldn't have done that you could elaborate on?
Fortunately, on the lending side, I'm loaning my own money, so I'm incredibly conservative. We turn down 90% of the applications we get. I got an application 2 weeks ago that the guy wanted more liquidity on his balance sheet so that he could get another loan for a different property. And so that he basically wanted me to lend him the money so that he could tell a different bank that it was his money. So yeah, that was a hard pass for me. I had another loan app that this guy was in a lawsuit with his business partner, and that he wanted money to hire attorneys to fight the fight, which is not the kind of lending that I'm interested in doing. Mostly I believe strongly whether it's loans or it's real estate or really any kind of business arrangement, is everyone has to benefit. If you have deals that it's like a win-lose scenario, it's like pushing a rock up a hill, that you have to start from scratch every single time to find a new deal. Whereas if you can create situations where everyone benefits, that's how you get repeat business, and that's how you get referrals, and that's how you make things sustainable, because it's, when you're loaning people money, they need to pay. That we're not in the foreclosure business. We're in the performing note business.
Right. A red flag for me is a $3 million loan request with 10 grand in the bank.
Oh, yeah. I mean, we'll get those, or I'll get, not so much with residential tenants, but with commercial tenants. I'll have people who they send me their bank statement. I'm like, dude, you don't have enough for first month in security deposit. Like
you don't have enough for a latte.
Yeah, no, I mean, we had one. I had done a deal down in National City, and these guys asked if they could pay their security deposit on a credit card. Anyways, switching gears here. Your future. What do you envision yourself, but both in your career as well as your personal investments? What are your goals, and what are you working towards right now?
Yeah, so as far as personal investments, my wife and I, after having a child, decided to buy our first house. So that emptied the supply of cash to put towards other things for the time being. I would like to buy more real estate. Actually, I told my wife many times I would prefer to buy cash flowing real estate before buying a home. However, I see the value in having a roof over your head for your family and a place to call yours. I get it. So I would like to own more real estate. I would like to position myself that I'm sort of a go-to lender for people, and if not a go-to lender, a go-to broker or a go-to resource. So whenever someone brings me an opportunity, if ever I think that there's another person that may be able to do it, if I'm a no, I always try to make that introduction, right? I'm sure you do too. You've been successful in the business for a reason, right?
Yeah, it's, I have found that this is a long-term thing. So I'll have people call me and I'll say, look, I'm not interested in helping you with this, but I'll give you 5 minutes of my time, and if it was me, this is what I would do. And, it's amazing that 3 years later, that person calls you back and they remember, and all of a sudden now they got a killer balance sheet and they're ready to do all kinds of big deals. And you were the only person who took the time to give them that free advice. And I think especially in such an impacted industry like commercial real estate is that the people who are willing to take the time to invest in their relationships in the long term are the most successful.
I agree. And I think the key to that is also not doing it for that eventual payoff, right? Is just doing it because everyone can do better that way. And it's sort of the abundance mindset. I lift you up. Eventually, I may get lifted up. Everyone will be lifted up. But back to sort of aspirations, one of the reasons why I decided to go with the firm that I originally went with, who was at the time a client of mine, or just before that a client of mine before I was laid off, was they had wanted me to stand up basically a San Diego branch of the business. They were a lender in LA. They had a fund. They said, hey, let's set this up. We'll help you raise your own fund. That to me, it was much more attractive. I really understand lending. I really understand capital markets. I understand finance and managing a balance sheet. So I felt that would be a really cool career progression for me. And I shared that with the CEO of where I work now. And he agreed that in order to do that, I need to work on my sales skills. And so that's what I'm doing. That's what I've been doing and will continue to do so. I really love the loan business. I love deals. I love building relationships with people. So I don't really have any aspirations other than that, like grow where I'm at. I do like to manage people and teams. So if being a fund manager or running a fund or founding a fund or whatever that ends up looking like, that's cool. I also am a bit of a like data nerd. And so things about like trading portfolios of notes and stuff like that are really interesting to me. And I've made some relationships with people that do that kind of thing. So I think that I'm building the skills that I need to build to do all of those things anyway. So that makes me happy that there's sort of an open possibility to what could be next.
That's awesome. So let me ask you this. Looking back on your journey, from starting as a junior credit analyst to now being a senior loan officer, if you could go back to the beginning, what would you have done differently?
There's lessons that I had to learn by doing lessons about managing teams and or being a senior member of a team and certain things like that. But there's no big career missteps or regrets or anything that I have that I look back on and I'm like, gosh, I really wish I would have done it differently. Of course, I wish I hadn't gone to another job where I ended up eventually getting laid off, but it led to where I am now. I'm pretty happy where I am now and what the progression is ahead of me. So I'm not really the kind of person that lives with those kinds of regrets. There's things I would have maybe done differently, but I'm happy enough where I'm at that I don't lay awake at night and think about them.
Well, I think that's a good way to live. The way I feel oftentimes is everything I did led me to where I am now, which is a place I'm satisfied to be with. So it's like as much as there were deals that didn't close and, situations that perhaps were happened poorly, all of them were stepping stones to where I am now, which I'm happy with. So, yeah, I would say I have a similar philosophy. Let me ask you this: for someone who is brand new, who's trying to jump into the type of thing that you're doing, what's the best advice that you would give them?
Just learn as much as you can. I think that provide value where you can, but more often than not, initially your value is in learning so that you can start doing. And the sooner you can start doing and doing effectively and anticipating the needs of others is typically how you're going to move up in the business, right? It's very rare for someone with no real estate experience for someone to put a sticker on your chest that says loan officer and then off you go into the world, right? You're typically going to have to work as a loan officer's assistant or a processor or something. So those are all about learning the hard skills that will move you forward. And those hard skills initially are to help someone else. So I would say just learn and grow and support. But also something that benefited me a lot early in my career was just networking with people around me within the business that I was in. So I was friends with people in accounting and people in appraisals and people in credit administration and all these different roles, not because I'm some social butterfly, but because I was genuinely interested in what they were doing. And I think it made me a lot more well-rounded to know what was actually going on around me, and then also to be able to network with those people about what was going on in different parts of the bank and where opportunities might be.
So if people are watching this and they want to work with you, what are the different capacities that you can help people, and who are the corresponding puzzle pieces that you're seeking out?
Yeah, so I would say I'm looking for asset owners that are looking for a new loan or looking to acquire a property and need a loan. I'm looking to work with commercial mortgage brokers who can bring me business and we can all get paid. I'm also looking for other lenders, whether that's bank, insurance companies, private lenders. I want to be able to provide my clients with a full suite of products. And then also, if you're someone that has a deal in front of you and you're not sure about it and you want a sounding board, I'm happy to be a resource for that kind of thing as well. As an outsider looking in, I wouldn't be excited about the prospect of making money, so maybe I can look at it more objectively.
And if people want to get in touch with you, what is the best method for them to do so? I
would say number one and probably the best, I don't even think number two is in the conversation, would be my LinkedIn. It's Dillon Freeman, Dillon Freeman. On LinkedIn, you'll see my smiling face in a jacket. You'll know it's me. If you click the link and you see someone complaining about interest rates and real estate, that's your guy.
Perfect. Well, Dillon, you have any just embarrassing stories that you can share with our audience?
I went to college in the Midwest in Iowa on a wrestling scholarship. So I went from LA.
I saw a little cauliflower ear.
Yeah, from LA. Yep, been hitting the head a lot. Got a little cauliflower ear. So I went, halfway across the country to a school full of people I'd never met. Maybe met, a handful of guys that were wrestlers or wrestling recruits. And on the very first day of school in the dorms, I was the guy that got stuck on the broken elevator.
Hell yeah. Well, Dillon, it's really just my mind is overflowing with all the quality information that you've shared. So I really appreciate you coming on. Any final thoughts that you'd like to share with the audience?
Not much. Just work hard and be happy and be good to people.
Well, hell yeah. Well, thank you so much for coming on.
Thank you, brother.
All right. Well, that is a wrap of episode number 3 of the Easy Deals podcast, sponsored by Palm Tree Properties. Of course, I would like to thank our sponsor. Palm Tree Properties is San Diego's premier residential and multifamily property management company. If you own rental units and you want to make more money with more peace of mind, consider reaching out to a company like Palm Tree Properties. All right, guys, that's a wrap. See you on the next one.